Hi, everyone. Welcome to Domain Sherpa. Today is an episode of Down the Rabbit Hole with Drew, myself, and Pedro de Noronha of Noster Capital. In this episode, we talk about the investability of domain names from the perspective of an institutional investor. Pedro brings a handful of questions to pressure test our thesis of domains as digital real estate, and we discuss some advantages and disadvantages to domains as an investment and what else is needed to make domains more appealing to institutions and funds. It's insightful and eye-opening to say the least, and if you're a domain investor, big or small, you surely don't want to miss it. So let's get right to it here on Domain Sherpa, where all roads lead to domains.
It don't matter what you say, there ain't no way that you messing with my team today. It don't matter what you do, I will not lose.
What's up, Sherpa Network? Welcome to Domain Sherpa. My name is Jonathan Tenenbaum, and I am the host and producer of Domain Sherpa, where all roads lead to domains. Today's show is a offshoot of our Down the Rabbit Hole series. As we say on Domain Sherpa, all roads lead to domains, and in turn, domains lead to all things. Today, we are going to be talking about the idea of domains as digital real estate and attacking our thesis of the idea of how do we make domains more accessible from an institutional investment standpoint. And to do that, we've got a very, very special guest. We've got Pedro de Noronha here with us. And Pedro, let me know if I said that correctly. But
perfect.
Excellent. And I've also got my main man, Andrew Rosner, here on the show with us as well. But let me do a quick intro for Pedro. Pedro is currently the founder and managing partner of Noster Capital. It's an artisanal investment manager with offices in London and Malta that provide investors with a high-touch service, able to explore investment opportunities across segments of the market that most funds can't. As for Pedro, he began his career as an M&A analyst at Merrill Lynch in their London office. After that, he moved over to JP Morgan's proprietary positioning team in London, an independent business unit reporting directly to JP Morgan's board of directors, investing in banks' own capital through multi-asset investments. He specialized in risk arbitrage of special situations in Europe, promoted to portfolio manager at the young age of 27, managing over 1.2 billion in gross assets. That's billion with a B. After that, Pedro decided to venture out on his own and launch Noster Capital in early 2008 with an internationally recognized group of individuals making up the investor committee. Noster's clients include very high net worth individuals as well as family offices. Recently launching a second fund, Noster Alpha Constant, the goal of complementing the first fund with lower fee, lower touch investment strategy, delivering over 66% return since the inception in October 2019 versus the 47.5% of the S&P total return. Obviously doing an incredible job there for their clients. He also sits on the board of B Corp Conservatorio, which is a real estate developer focused on mixed use, mixed income projects in Panama, Guatemala, Honduras, with a $500 million pipeline. I think it goes without saying, it's a long intro because you got a ton of accomplishments, but I hope I did that justice. And Pedro, thank you so much for being on the show. We appreciate having you here.
My pleasure, JT. It's great to be here with you guys.
All right. And as usual, we got my man, Andrew Rosner, who is the founder and CEO of Media Options, the #1 domain brokerage firm in the world. Also the owner and publisher of Domain Sherpa, owner and publisher of Ganjapreneur, one of the biggest domain investors in the world, also a very big crypto investor. I mean, I know anybody who watches the show knows exactly who Andrew is, but I feel like after giving Pedro such the long intro, I got to do justice to Andrew and give him his props as well. But Andrew, thanks for being here also.
Absolutely. And just to fill in the blanks, Pedro and I met briefly while I lived in Panama, just before I left Panama. And we were introduced through mutual friends. And shout out Casey and Patricia. And we have become very close friends. And I am a investor in the asset manager that Pedro operates.
Awesome.
Yep. And in the interest of full disclosure, Drew is the one person who made me fall down the rabbit hole of Bitcoin because I was a huge contra until then. So.
Yes, excellent. Well, that's great. And yes, and since this show, having an actual institutional investor on the show, nothing on the show constitutes investment advice or financial advice of any kind. We're just a couple of guys having a conversation, talking about domain names and some interesting things to us. And hopefully you all will find it interesting as well. So with that, let's dive into the reason that we brought you on, because I know you guys are close friends. And obviously with the fund that you manage and the different investments that you have, you're on the institutional investment side. You know, we've got this, what we kind of call our default thesis of domain names as digital real estate, right? And part of the, you know, your role, Pedro, and what you're involved with is, you know, also a big real estate investment trust. So, you know, I think for us, what we all would like to do on today's show is talk about the idea of domains as digital real estate. And also, as we keep going down this path of trying to make domains more accessible and investable by individuals, but also funds, trying to talk through a bit of what will make domains more, you know, more available, more
Appealing.
enticing, and exactly appealing. I said enticing, you know, to investors of all shapes and sizes in order to help to advance the idea of domains as its own asset class. So with that, let's kind of dive in. So let's start first to level set from a domains perspective. I mean, are you a domain investor yourself? Do you have domains for your business? Do you invest in domains as an investment?
I invest in domains just for the business, and I have a personal domain so that and Drew gave me for my birthday last year a domain extension .Noronha, which was incredibly cool.
So the handshake
okay.
domain.
It's a handshake. Yep, decentralized web. You know,
but
Pedro's
the way
on Web3.
Yeah.
Without knowing what Web3 was.
Yes.
But JT, tell me, I think the way that this could be more productive is if we run this session almost like a due diligence conversation where me as a potential investor ask you guys questions, which
Sure.
I think most people would like to know to understand what is the investability of domain names as an asset class. Because to be entirely honest with you, until I met Drew 3-4 years ago, for me, domains was just you know, the storefront for your business, and I mean, I didn't understand the appeal of it. Now, after dozens and dozens of hours of conversations with him, of course, it looks entirely enticing, and I think it could be very well a very interesting uncorrelated asset class. But there's a couple of hoops that we have to jump first. And I think that are probably questions that most people who are looking to invest in domains would have. So
sure.
I did a list of questions, and let's see where the conversation leads. And I'm sure that none of them probably will be new to you. Hopefully one of or two will.
You're the best kind of, you're the best kind of guest, man. You come prepared and you know, ready. And I think that's a great approach. And I think that'll be really helpful and useful for a lot of folks. So go ahead.
And if you we're gonna gamify this. So if Pedro can stump me, Pedro, we're gonna send Pedro some of the new DomainSherpa swag that we just produced.
Okay, yeah. Shop.mediaoptions.com. I got a bunch of stuff coming in the mail, so you'll start seeing that on the shows, and as we're starting to send that out to the guests and things like that as well. So good stuff. So all right, Pedro. So let's see. So where do you begin? So, you know, as in your due diligence.
You know, I think the first thing as an investor that you think of when you buy anything is to think of the future. So the first question is, how easy is it to sell a domain?
So domain names are not a particularly liquid asset class. I would say that the trajectory on the liquidity of these things is certainly up and to the right, but at a very slow pace. Although, albeit, you know, I would say increasing, and the trajectory has increased, you know, gotten steeper because of COVID, you know, which just amplified the need for, you know, a digital presence and amplified the need for the best possible digital presence for any brand, company, service, product, et cetera, because you're competing in the most competitive landscape, economic landscape there is, which is the digital, you know, economy. The domain names are not particularly liquid. There are subcategories of domain names that offer a tremendous amount of liquidity, but you know, such as three-letter.coms, you know, there is a floor price at which you can sell a three-letter.com more or less instantly. You know, instantly being, let's say 24 hours, 48 hours. And, you know, same to a lesser degree could be said about four-letter.coms, and we're talking about just a random four-letter string acronym. There's, to a lesser degree, again, let's say oneword.coms. Every oneword.com has a floor, but they're going to vary tremendously based on some of the stuff that we'll probably get into, later in terms of how to value domains. But there is a low degree of liquidity versus other traditional asset classes.
Got it. So basically what you're saying is the Madison Avenue sells super easy. If you're going to, something that is less prime, it might take a little bit of an effort. But that's why guys like you exist, I guess, right?
Precisely.
Well, yeah, and I think it's also worth mentioning too, one of the nuances, 3-character.coms, like, 3-letter.coms have sort of a floor price and there are enough people in the market and there are enough platforms out there, different, sale, NameJet, for example, different domain name sales platforms where you can list a domain and sell it, or Afternic, where you can sell it relatively quickly, where you have enough buyers that are actively watching what is happening in the flow of inventory and generally have an idea of what they're willing to pay. I also think for 3-character.coms, because the floor price probably sits around $30,000, somewhere between 20 and 30 grand, depending on the letters. And then, that's also a price point that is accessible to a number of investors. Whereas if you take like a singleword.com, that might have a
or
value.
2-letter.com, for example.
Or there's a 2-letter.com that could be a 7-figure asset. Even though that's the sort of floor price, if you will, not every domain, there aren't that many people that are liquid at however many millions of dollars to invest in those kind of domains if somebody is actually actively selling those, so I think that also adds another layer to it where, it's called the available cash or investable, dollars for certain domains, which is kind of why I think you've seen this prevalence of, if you look at what is the most liquid domains at in a range that's accessible and by buyers that are aware, I think your 3-character.coms probably are the kind of the most prevalent in that case. So but yeah,
I think that's a great sort of segue into a deeper part of maybe the same question, which again, I'm hesitant to go too deep because I don't know what other questions you're going to throw at me down the line. But I think one of the biggest opportunities and problems, again, every problem is an opportunity, but the biggest problem that we face as domain investors, I think, is the spread, right? So, in traditional markets, there's a spread, and generally that spread is not going to be that steep. When spreads start widening to, let's say, 3%, 6%, whatever, at least in my uninformed mind, that would be a very large spread in traditional financial markets.
Yeah, for sure.
And in domain names, if we stay with the example of 3-letter.coms, which I think is a great example just because it's the closest thing to, let's say, an investable asset class within the domains themselves, because there are, let's say, there's a large number of buyers of last resort, such as myself. I will basically buy any 3-letter.com. Anybody, I don't care who you are, I don't care what your domain is, you present me a 3-letter.com, there's a price I will pay for it. If it's the worst one in the world, I'll still probably pay 14 grand for it, maybe 15, right? But for most of them, I'm going to pay 20 to 30 grand, doesn't even matter. I'll give you an answer in 30 seconds, send me a domain. If it's a 3-letter.com, there's me and maybe 50, 100 other people that will buy that domain within a 10 or 20% range, and call that the floor. But on the flip side of that, once I own it, what I'm looking to sell it for is 10x in general. Sometimes it's a 5x, but more or less I'm looking for a 10x. And so the spread between, let's say, the liquid price.
But that comes with time, right? The 10x is going to be over 3 to 5 years. It's not going to be over 3 to 6 months.
Time is variable. Sometimes it happens very quickly. We say lightning strikes, but for the most part, yes, it's a longer hold. It could be, let's say, 2 to 5 years is probably our average. I think as we move out the time scale, as we move up the quality scale on domain names, that time frame gets compressed. But for the most part, you're absolutely right. This is going to be a longer term, mid to long term hold. If we're calling a midterm, let's say 5 years, and long term 10 years, or 10 plus, I think it's a mid to long term time frame. But again, what I'm just trying to highlight is the discrepancy between liquid value and retail value.
Mhm.
And it's a very large spread. You know, it's a multiple, not just a, you know, small percentage, single digit percentage or so.
And like
Oh,
you
but
said,
that's
that
what you-
represents the opportunity, but you know, as well. So I'm sorry, go ahead, Pedro.
No, that's what makes you guys experts, right? You dedicated your lives to understanding this, so that's how you make a living, and that's totally fair. Now, a question I have is about transparency. How transparent is the market? Can I see, well, just like in Bitcoin, you can see what Bitcoin came from which wallet to which wallet. Can you see the provenance of the domain and the prices paid historically for it?
So very little, I would say 90%, particularly on high-end domain names. On the low end, there's a lot more transparency in terms of pricing, just because most of the transactions are happening on marketplaces or platforms where they have a general policy of publishing their sales data. On the higher end, where somebody's hiring somebody like me to go buy the domain for them, or hiring somebody like me to go sell the domain for them, we don't publish any of our sales unless specifically requested by both buyer and seller. And so at the high end, I think it's greater than 90% of sales never get published. And therefore you have very little, almost no transparency. You have the occasional exception, but
don't you think that harms the industry as an asset class? Because imagine the contemporary art industry, if you wouldn't know how much Picassos are going for year in, year out, or any other artist, you know, it's the FOMO that drives people into contemporary art. Well, FOMO and ego, of course, but I think that the industry would be better served by being more transparent, because people could, from the outside, start saying, well, hold on, this is appreciating higher than the S&P 500 or than this asset class, and zero correlated returns.
Yep. And I think you make a really great point. And we've talked about this a lot. And there have been sort of times and in different pockets where there has been more transparency. There are things that have changed. For example, GDPR, when it was introduced, changed the way that the rules around publishing the whois data for the domain name, showing who the registrants are, right? So as that information became less public, then you have less transparency about domain movement and ownership and provenance. To your point, you know, there are sites out there like namebio.com and a few other, and there are blogs and folks that do track the sales prices on some of these platforms, like I mentioned, you know, which is like NameJet and Dropcatch and GoDaddy auctions, and places where you have domains that are being sold every single day. So there are places that do effort to try to track those sales, but you know, not every, you know, they can't track them all. There are tons of private sales. Not all of the platforms publish their data, and not all the sales that occur on these platforms are necessarily public or within view of people. So, you know, and this is
the PR is being done by the suburbs rather than by the prime real estate, right?
Yes. Unfortunately, that's actually precisely correct. And so this is a very tricky issue for me personally, because our clientele are at the very high end of the market. We're only really dealing in the top 2% of the domains, and they value privacy, right? You know, we go out and buy a domain name on behalf of a Fortune 500 company. They don't want that to be public for a variety of reasons. First and foremost, they don't want their competition knowing what they're doing. They don't want the name of a new product or a service getting out into the public domain before they get to make the announcement and control the narrative. And so, and a lot of other reasons as well. And on the flip side, you know, various investors, anybody who's tried to buy a high-end domain often knows it's very difficult to even find out who owns it. And even if you know who owns it, to contact them can be very difficult. And a reason for that is that a lot of the domain investors who have owned these domains for many of years, they value their privacy, because you have people that really want these things and are literally banging down doors to try and get them.
But you don't need to know who bought it. You can have undisclosed sold abc.com to undisclosed. The only thing you need to know is actually the value.
Yes, except that by the nature of domain names, you know, ultimately that information will become public once it becomes in use. And so it's tricky. Yeah. It's a very, I would say probably one of the trickiest subjects in the field of domains is, you know, price privacy. And so you have a high degree of transparency, which literally, is let's say the flip side of that question you just asked is you have a high degree of privacy, a high degree of transparency in terms of who owns it, who sells it, with the exception of the new GDPR rules that sort of have obfuscated that. But if we're focusing our conversation on high-end domains, these are going to date back 20 plus years, and there is going to be some degree of transparency in terms of who owned it previously, and ultimately when it becomes in use, we'll know who bought it. And so I'd say there's at least some relatively good degree of transparency in terms of ownership and provenance, but very little transparency in terms of price.
Yeah, I guess price would be more important than provenance, because once you have the website, you have the domain, you have the domain, right?
Although social proof, as we've seen in Bitcoin, is such an important thing. You can be one of the top institutional investors in the world shunning Bitcoin, and then Paul Tudor Jones jumps in the ring, and you're like, oh, wait a minute, it's time for me to take a second look at that, right? Mm-hmm. And so, the provenance is quite important. If you see a Facebook or a Amazon or a high net worth individual spending a big chunk of cash, like Mark, what's his name, the Mavericks?
Mark Cuban.
Mark Cuban, steps up and buys democracy.com for $300,000 just on speculation. That sends a signal to people like him, people in his circle, who say, oh, okay, domain names are a thing. It's whether it's for a social signaling or whether it's for, just business use and, assigning a value, it sends a number of signals.
And for what it's worth, we do get sort of a patchwork of information and data just through some of the things that I mentioned, where some of these sales that occur on the platforms, the big super premium stuff that is often sold via, private sales, some of that information then becomes public later on through actual public filings on the part of publicly traded companies. And, you have some people who do a lot of work to actually try to dig in and, monitor those filings to see what they paid for those domain names. The unfortunate thing is it doesn't come until, potentially quarters or months later. And
years,
to like George Kirikos and, folks like that, and Elliot Silver and others who, Jamie Zock, I think, and, you got some
digging
people
through these S1s
in the space that literally take the time to go through to try to determine what these big domains sold for, to get a sense of what the market is actually doing, which is,
I wonder if guys like you who see a leading part of the flow could build some, prime domain index where you don't disclose what you do, but you can just start it as a basis point of 100. And then, because, one thing when someone is investing in illiquid assets, which, compared to, stocks, you guys would be considered illiquid.
The opposite end of the spectrum of liquidity.
The more data points, the better. So
yes.
You want to create news. So if you have prime domain index that comes out once a month and that registers at least the main sales that you guys did, and given that you guys are the number one brokers, that could be a data point that is relevant, so that people can then, because one of the questions I'm going to have is, okay, I build a portfolio of domains. I'm sold into the idea. How do I value it on a quarterly basis? I'm not going to say month to month, because that might be too soon. But the problem when you have a fund that is not closed, and by that I mean where investors can come in and out, when you have an asset that is illiquid, the question is, how do you value the asset? Mm-hmm. There's the option that you can put it always at cost, but if you keep it at cost, an investor who invests a year later is getting in the price of last year, which is not fair for existing investors. So you're always trying to make it as fair as possible. And what are the ways that we could do that?
I want to interrupt you for 1 second, because I think what you just said there is like one of the key points. This is why I wanted to do this is, these are concepts that I think most domain investors aren't thinking about. I think that we've had this narrative for 20 years in the industry of, domain names need to be an investable asset class. Domain names are digital real estate. But without flushing out, what does that mean? And I think the point you just made about, okay, most of these funds are open-ended, and you need to be able to mark to market, because as you said, somebody who invests, let's say I invest into your fund today, and you've got a portfolio of $1 million in domain names, and JT jumps into your fund a year from now. I mean, I would argue that domain names have been, in my experience, as somebody who is invested in, no longer, I don't have any bonds anymore, but I've invested in bonds, equities, real estate, domain names, you name it, all sorts of crypto. I've tried to at least dabble in as many asset classes as I can possibly get my fingers in. And
I can verify that.
Digital monkeys, you name it. So
API Club.
I would say domain names have appreciated at a faster pace than any other asset class I've ever invested in, including Bitcoin. And so it is not fair that an investor that comes into the fund a year later is coming in at the same value. And
exactly.
Then as a portfolio manager, what do you do about that, right? So maybe it's worth digging into that subject a little bit more, because I think this is one of these finer points that you sort of just go right through, because this is just common, this is first nature for you. But I think the domain industry it's probably never occurred to a single person in the domain industry okay, let's go start a domain name fund. Well, how do you mark that to market? It's an excellent question.
Right now, the only way you can do is you can do it as a closed fund. So you raise the X amount of assets, you invest, and you do it like a private equity fund. But there's no reason why this could not be like a long only fund. Just as there's gold ETFs, there's silver ETFs, there's Bitcoin ETFs. I don't see why there wouldn't be a domain name. So
I have an answer that I'd propose. And so you have, and I would just like to sort of get your idea about how valid is this. But one of our biggest partners, escrow.com, shout out, they are the market leader in domain name escrow. So I think they've got something like, I don't know, somewhere between 80 and 90% these days of the aftermarket for domain names, third-party transactions, escrow.
So they're like the clearinghouse of the domain industry.
Not the clearinghouse, because they're not like standing up a marketplace or an auction or anything. They're just a facilitator. They're an escrow facilitator. They do have a bunch of offerings in terms of payments, in terms of, other stuff. But for the most part,
that probably makes them the most knowledgeable guys about every price that is being transacted.
Okay. These guys know where all the bodies are buried more than any other, node in this industry. And so they do publish a quarterly report, which, is a quarter over quarter, guideline of, okay, market was up, market was down. They drill down into specific categories of domain names, whether it's 2 character, 3 character, 4 character, 1 word, 2 word, domain names, standalone versus domain names with a website on top. They drill down into these subcategories, and they do, they offer charts and graphs and sort of quarter over quarter indications of growth or contraction. And so, obviously, without seeing that, it's hard for you to judge. But I wonder if that sort of very high level market pulse, is a good indicator. Further to that, you've got, guys like Giuseppe Graziano, who is a good friend of DomainSherpa and of mine, also lives here in Lisbon, by the way. And he, GGRG, although I think he's publishing it on something else now. Sorry, I don't remember what the acronym is, but
yeah, I'll check.
He also publishes a quarterly report, which is only focused on the liquid side of domain names and only focused on, let's say, the sort of wholesale liquid area of the market. And he's got an traditional economics background, so he's sort of going into, okay, 3-letter.coms, these are the market movements, 2-letter.coms. But I think, I don't know if there's enough publicly available data for him to chew on to create a really accurate, overview of the market. But I think escrow.com does.
But listen, from what you're telling me, I think a JV between you and escrow.com to create the domain index And you can do several. You can do the AAA, which is the Madison Avenue. You can do the Central Park South. You can do the suburbs. You can do the, you know, the GoDaddies, the ones that we buy for $14.99 or something. And then you can compare. And I think that, you know, most institutional investors are lazy by definition. So, I mean, one of our slogans used to be like, we actually read the 10Ks, because the majority of investors don't read the 10Ks, which is something absurd, in my opinion, for someone who's a fiduciary of someone else. Yeah. You need to do the work. You need to present the data, and then you'll get people. And you could actually, you know, you could license the index eventually. First, you provide it for free, and further down the line, 5-10 years from now, you like the S&P 500 index is licensed, you know, especially if then ETFs are built on top of it. You could, there's a bunch of things that then you could like actually benefit from doing that. You could actually provide evaluation services for domain names. You could be like, hey, we're the #1 broker in the world. So for a fee of X, if there's a fund who starts up, on a monthly basis, we'll use 5 different methodologies that are proprietary, and we'll do it this way. Because if there is a trusted party in a world that is becoming more and more decentralized, but sometimes you need a trusted party to tell you, okay, just like there's the PwC and the Deloitte, I mean, you could be an auditor for value of domains. And your stamp would say, okay, this is fine. These guys are fair. Their prices tend to be verified later by follow-on transactions. And it could be a very good way for you, because if service providers like you guys don't facilitate this, you know, institutional investors, unless they're really, really like curious, and there's a few, will be too lazy to do this. And you have to think that we always have to sit on the other side of the table from our auditors and say, as an example, our fund invested in Bitcoin, as you know, since 2019. But it became through organic growth a significant position as of the end of last year. So we're audited by Deloitte, Big Four auditing firm. We had to delay the audit of our fund because Deloitte said we had never dealt with a fund holding Bitcoin, and we're holding Bitcoin through Fidelity. You know, it couldn't be more blue chip than it is. It's a statement from Fidelity. Everybody trusts Fidelity. And we had to delay our audit because Deloitte had to find the best procedures and so on. So this tells you how early on we are into institutional investing in the digital space. Okay. And I would imagine the domain name would be the same thing. If I invest in domain names, I would be having the same number of sessions that I had with Deloitte in the past couple of months, explaining to them and so on. You know, so and most people don't want to get through that, especially if they don't see a graph that says this has been growing at 35% a year. You know. Yeah. So you need to put the carrot in front of them, and I think that's what the domain industry. I mean, if I didn't know you, Drew, I would have no idea that domains would be a good investment. So, so the industry as a whole is doing a terrible job marketing this as an alternative asset class and correlated. You know, especially at a time where hundreds of millions of people are invested in bonds at yields of under 3%, where fiat currency is being debased at 10% plus. So you're locking in a guaranteed loss, and inflation is just around the corner. Even though the central bank say it's transitory, let's see about that. So domain names would be just like crypto is, an obvious solution for someone to get out of their fixed income exposure. But, you know, investors are lazy. After 30 years of making money in bonds and bonds being at all-time highs, they are so drunk with their own Kool-Aid that they don't see what's going to hit them. Yeah. So you guys have a unique. Go ahead.
Yeah, I'd love to just have an answer to that question. It's like, unless you're regulatorily required to be holding government bonds, what on earth, when the CPI print is 5-6% and these bonds are yielding, you know, between 1.2 and 2.6 on a 30-year? I mean, like why? Like what's going on in an investor's mind to hold bonds when you're guaranteed to lose money?
It's not because they're stupid, believe me. Fixed income investors are some of the savviest investors in the world. Some of them it's for regulatory reasons. Some of them is because it's the only option. They cannot be, banks don't want cash. I don't know if you're noticing the repos that they're doing every day, because the Fed is penalizing banks for having cash. So banks don't want cash. So sometimes you need, and you don't take credit risk on the bank if you own a piece of bond. So sometimes, especially if you're worried about the fragility of the financial system, and I think there's plenty of reasons to be worried, because this apparent sea of tranquility that we're all seeing is just there because central banks are printing right now at an annualized $7 trillion a year. I mean, how much longer? This speaks loads for investing in digital real estate, because one thing, you can invest in real estate. You can buy a Madison Avenue apartment building, great. But students of history know that in the past, when experiments like the one we're going through right now, where the government decides that printing money out of thin air works, and it works until it doesn't, the next target will be taxes on the rich. You know, and in the US, you had 90% tax rate last century. In Europe, in a couple of countries as well. And so the apartment building in Madison Avenue, when tax rates go up the roof, you're gonna lose 90% of your value. Whereas if you own
immovable property is going to be the bullseye of tax policy over the next 10 years.
That's precisely the point. Whereas if you own $100 million of AAA domains, your domains cannot be taxed because you can be a resident of anywhere.
Yeah, you can move jurisdiction on a domain name in 3 seconds.
And I think that's in it. So just to kind of circle back, right? And I do want to make one point, and this is just to promote our stuff a little bit. When you talk about, you know, we do have a domain appraisal service that we offer. You know,
I got it. I didn't know.
Investors. No, but this is more on individual domain names. So we have companies and domain investors and buyers and sellers of domains all the time that, you know, are looking to us to understand what they think their domain should be selling for, or they want to buy a domain and they're trying to get a sense of what should they be looking to pay for the domain. So we do have a domain appraisal service that we do offer, more on the one-off domains situation, not put together, you know, services to a fund. So I think that's super interesting. And there's no doubt that there's some really cool things that we'll be able to explore, not just talk about here, but further explore beyond this, which, you know, I think, you know,
I like the index idea.
So we just found
really interesting.
We just found you 2 additional revenue streams, guys.
Exactly.
We've got a new business line.
Yep, exactly. So speaking of which, so let's do that really quick. Since we're promoting our business, we're going to take a quick break, jump to a commercial where for our sponsors, and then we are going to come back here on DomainSherpa, where all roads lead to domains, with Pedro de Noronha. Continue to talk about this because I mean, this is so far so good, man. This is awesome. So let's keep it going. We'll be back here in a second on DomainSherpa.
Media Options is the industry's leading domain broker specializing in domain acquisitions, high-value domain sales, and domain name consultation. As pioneers and thought leaders on the subject of the domain aftermarket and domain name value, plus through their clear domain acquisition service, Media Options offers startups and established corporations an unparalleled scope of high-value domain options, providing access to domain names and curation technologies not available elsewhere. Media Options believes in the power of a great domain name and is dedicated to helping you obtain yours. Call or email today to put a domain to work for you.
Welcome back, everybody, to DomainSherpa, where all roads lead to domain. So let's just dive back into it. So Pedro, I know you've got a list of questions. So let's move on to kind of the next question on your list.
Perfect. So the second one is, what defines a domain desirability? I know that the number of letters for sure, and words as well, but I don't know much more than that.
Yeah. So from, you know, this to some extent is a matter of debate, but I would argue that, you know, this has been settled, you know, but I would say that the value of a domain name is derived exclusively from its use in commerce and use in culture. And when I say use in commerce and use in culture, I'm talking about the SLD, the part to the left of the dot. So if we're talking about Pedro.com, Pedro is the SLD and .com is the TLD. And so if we take the SLD, the part to the left of the dot, and we measure how many people per month are searching for that keyword or acronym or phrase, and we go to Twitter and we see how many, handles and hashtags are using that exact, SLD, and we go to Crunchbase or in LinkedIn and we say how many companies, are using that SLD, how many trademarks are in the, United States Patent and Trademark Office database using that exact SLD. That is going to give us a measure of the, in the investment world, the TAM, right? The total addressable market. The TAM can be measured by how many people per month are trying to find that, utilizing it, whether it's search or utilization per month for a particular, acronym, keyword, or phrase. And then the other side of that is the valuation part. So that's measuring the TAM. And then what is the TAM, worth is measured by competition and by what are advertisers willing to pay for that particular keyword, phrase, or acronym to Google or Yahoo or Alibaba or, Baidu or, it doesn't matter. Any of these channels, what are the advertisers paying for that keyword? In the case of something like car insurance, you're talking about, hundreds of dollars per click. Whether that person converts to a paying customer or not, the advertiser is going to pay hundreds of dollars, meaning that, let's say, if we assume a 2% conversion rate, which I think is a very reasonable sort of just broad-based conversion rate for e-commerce, you're talking about 98% of the people that click are not going to convert, but the 2% that do are worth so much that you can afford to pay hundreds of dollars for each click. And again, that's for something like car insurance, one of the highest value keywords on the internet. Because many people buy car insurance, or almost, probably today, it's the majority of people buy car insurance on the internet, versus something like directions, where you've got millions of people per month searching for directions and typing in the word directions into Google, but very little or nobody paying as an advertiser for that keyword because it's a product and a service that's given away for free through Google Maps or Waze or whatever. And so those are sort of two ends of the spectrum. Or you've got something like, something very esoteric or made up, which nobody is searching for. And so it's sort of a quadrant, right? And one axis being, search, and one axis being, sort of the value of the search or the value of a click. And but that quadrant is how you would measure the value, right? It's
and you just made the case for why a company like yours needs to be a service provider for an institutional. Because for us to be able to do that analysis, which you guys have tens of thousands of hours of doing that, it's very tough it's very different from what we normally do, which is looking at cash flows and, understanding business models, trying to estimate where they're going to be 5-10 years from now, and if they're fairly valued or not.
Yeah.
So,
and Drew, so how do you reconcile that with like onewordpremium.coms, right? You take a name like looking at something in our portfolio like lobster.com, which you could utilize as would be a potentially a brand name going forward. So the name has value, and that oneword.coms are extremely high value domain names, but the search isn't necessarily related to what the ultimate end use could be, right? So, so how do you reconcile that?
Yeah, this is where we get very tricky. So what I've discussed up to this point is very much about objective value, okay? A data-driven approach to objective value. And I would argue that, in a perfect world, as we move down that spectrum of liquidity, what we're trying to achieve is getting the liquid value as close to the objective value as possible. Now, there's a whole other side, particularly at the very high end, which is subjective value. And sometimes subjective value can be a order of magnitude or more greater than the objective value. If I own, trunk.com is a great domain name. It can be a great brand for a number of things. And somebody like, I don't know, Trunk Club could come along and say, I want to upgrade and just own trunk.com. And, they would pay X for it. But Google could come out with a new vault service for all of your digital assets tomorrow. And it's called Trunk. And they've got trunk.google.com or google.com/trunk. And that's your digital vault. And it's now worth, subjectively, potentially, tens of millions of dollars. And so I don't know. I don't know how you assess the subjective value, because it's very much driven by sort of timing, circumstances, egos. There's a bunch of these subjective, intangible things that are very difficult to measure. So
that's what makes, just like investing, it's more of an art than a science. There's a science component to it, and then there's
And we say that
and
about domain names.
and some luck as well.
Yeah, we say that about domain names a lot. Digital assets in general, there's a lot of art and science, especially when you segue from domains into something like NFTs, which has an actual art component to it. But domains are almost, whereas I think, crypto is a little bit more science than art. Domains probably fall somewhere right in the middle, And
I don't know. I think to some degree, simply because, if we say, if we focus on Bitcoin and we say, well, Bitcoin is, it's fungible, right? You can, one Bitcoin, more or less, they're trying to break that, but one Bitcoin is worth another Bitcoin, right? And that's more or less a universal truth. And then in the domain world, each one is a snowflake, each one is unique. But I think that if we break it down to its lowest common denominator being, let's say, search and CPC, cost per click, you can measure them eye to eye, even without knowing what the domain is. If I give you a set of statistics, this domain name, call it X, has, 50,000 exact match searches and a $4 cost per click. And here's the domain name Y, it's got, 40,000 searches, but a $10 cost per click. Which domain, how do you compare those two domains? I think on the objective spectrum, you can compare them, apples to apples. But in the subjective realm, you cannot. There's no basis to compare them. And I think in Bitcoin, you can look at that in a similar way, that we can look at the objective value, which is if you are, whether you're a day trader or a long-term holder, it doesn't really matter. You're entering the market at any given moment in time. There is a point at which Bitcoin is liquid and you can buy Bitcoin. That has absolutely no relevance to the value of Bitcoin as a network and Bitcoin as a more macro concept, right? Just because I can go right now and buy a Bitcoin for something between $39,000 and $40,000 at its time of showing, August 2nd, 3 p.m. UK.
It's time of taping.
At the exact same time, if you're a, let's say, longer term holder and you're trying to analyze what's your entry point, you're looking at, well, what can Bitcoin be worth? And that's the subjective value, because it's going to be subjected to time, circumstances, regulatory behavior, a whole bunch of different variables that are unknowns. And I think that that's similar. I think that domain names have an objective value, which is, right now we have quite a large delta between liquidity and the objective valuation. And I think with time we'll close that gap. But there will still be the subjective value, which is another wide margin that can be gained from circumstances. From suddenly you have a startup that raised $100 million and they need that name. Suddenly,
Fed policy,
right? COVID, right? You had a floor price
other trends with
names.
respect to specific domains as well, right?
Exactly.
And I think that's also where.
So I think when you look at Bitcoin, you look out, 5 or 10 years, and you have very, very, very smart people coming up with different models of how to subjectively value Bitcoin in the future. And they're saying, could be 400,000, could be 500,000, could be 1 million, could be 10 million. And that is a subjective value based on, okay, is Bitcoin going to eat the gold market? If so, Bitcoin's worth $500,000 today, even if the price is $40,000. Is Bitcoin going to eat the bond market? If so, it's probably worth $10 million each, even if the price today is $40,000, right? And so there's these subjective factors, which is how you would subjectively value Bitcoin in the future. And there's these subjective factors on how you might value domain names in the future if a startup with a significant VC backing emerges, if a Fortune 500, decides to name a product or a service, in line with your domain name, if a domain name in the same lane sells for, some unexpected valuation, that's going to move up the floor for your name, right? So I think that these are correlated. There's a relationship between objective and subjective value, but you can only measure the objective.
And there's probably a very strong case to be made about scarce assets like domain names in a world where all major central banks are printing like there's no tomorrow, where there's completely cornered and everybody have realized that they're cornered and that the only way out for them is to inflate their problems away because they're not going to increase taxes. That's super unpopular. Right now they believe the magic money tree is working. And it has been since, it has been. Burr. Exactly. But they forgot to read the lessons of history and to see that all those experiences ended in the same way. And when
you mean it won't be different this time?
I wouldn't bet my farm on it.
Yes.
So until we have a monetary system reset, and that could be 5 years from now, that could be a month from now, that could be 20 years from now. I mean, God knows how much longer this could go on. Anything that is scarce and that is digital is going to be probably outperforming. I mean, if you look at since 2008, since the great financial crisis, there's very few things that outperformed the S&P 500. And the S&P 500 was majorly driven by the big tech. So there's Bitcoin and the cryptoverse. There's probably very high-end real estate, S&P 500 and domain names. I mean, I don't know what else has outperformed. The only way that you wouldn't be relatively poorer is if you had a big chunk of your portfolio allocated to any of these asset classes.
We talk about digital scarcity all the time. We've got scarcity.com. That is obviously a big driver. We believe, and we know that. And when you have something like domain names that have utility, and then you also have scarcity, Drew's comment of each domain is a snowflake, which, was a term that I coined. So trademark, all rights reserved.
Well done.
And Drew's got off the market forever and a lot of other good ones himself. But but without a doubt. And I think that, because the idea that you've got more and more folks that are going online, you've trends like COVID and everything else. And we've talked about this ad nauseum, this idea of, the transition from physical and analog to digital. And they're not, and so more and more folks need good domain names to be able to operate online. Then, that only further drives the value of the premium domains because and
keep one thing in mind, JT, I don't know if you have kids, JT, I know Drew does, and mine are a little bit older. I look at their friends and kids already live it partially in the digital sphere.
100%. Yep. And I do. My kids are like Drew's kids' ages. And yours
a little older.
Like, a little bit.
You're getting a little more. Well, no, it matters because you're getting more of that experience. Your kids are, doing some games. They're doing, they're more, even more, involved digitally than mine are yet.
Yeah.
But I can see my oldest one already going there.
But you see it, you go to restaurants and parents don't have nannies anymore. It's like, here's my iPhone, or they have their own smartphone.
Oh yeah.
And that's a pacifier, it's like the kids are, but they don't understand the kids are already understand the board ape yacht club that Drew is so invested in. And those things, for them, it's natural because they live partially. So the biggest resistance to changing and investing in the digital realm comes from mostly older investors. The younger generation, it's totally down to it. They can understand something that is not tangible, something that is abstract. A domain name is abstract. And then COVID, I think, just accelerated the transition because many people, believe it or not, outside of the US, don't do online shopping. And nowadays, people realize instead of having a piece of real estate in the main commercial street in my town, I can just have a website and I have a warehouse, and I can sell to the whole country.
Oh yeah.
To other countries. So I don't need the expense of the Madison Avenue, unless it's for prestige, and luxury brands need that. But if you're not a luxury brand,
but domain names serve that same prestige role to the younger audience, right? Maybe, let's say, I don't know, if Tiffany's bought diamond.com, the 60, 70-year-old guy walking into Tiffany's doesn't care or know that they don't own diamond.com, but I'm saying if they did. And but for a young audience, that is prestigious. It's like, oh wow, that's a flex. That's a flex that Tiffany's would own diamond.com or De Beers or whoever. Right, that is a sign of prestige to a younger generation.
And it's also accessibility, right? So when you've got younger folks that are looking to possibly purchase a diamond ring, what have you, they're not necessarily going to Google Tiffany's or De Beers, but they'll Google diamond, and then it'll
exactly,
and it'll drive them to it. And as you have the metaverse that is becoming more and more prevalent, you've got Facebook coming out and saying that they're not a social media company going forward, that they're a metaverse company going forward, with the idea of literally creating these storefronts that are existing, everything existing online. And eventually, people will go in with
which, by the way, should be like an entire show in and of itself, just breaking down like, what does that mean? Because I feel like from mainstream media to like even, esoteric podcasts and media, nobody's talking about this at the scale that it should be discussed, which
is the metaverse.
Well, just that Facebook is going all in on the metaverse today, right? Like, this isn't like, there's some nascent little corner of Facebook that they're talking about the metaverse and Zuckerberg's not even in the loop yet. It's like, no. We're going to take how much are they worth? 100 billion or something?
Yeah, probably more.
They're going to take a $200 billion company, and we're pivoting the entire business from social media to we're going to be the place in the metaverse that people come together, host events, get, whatever, like all of this.
But that's a defensive move that they're doing, right? Because according to the teenagers that I know through my kids, Facebook is for boomers, right? It's for us.
Yeah,
it's not for them.
It's both. It's both. I think.
But they also own Instagram, right?
Yeah,
so
Instagram is
so they're still tied in, and so they've got the old folks that are on the internet on Facebook getting all their misinformation there, and then then they've got the the younger generation, although they don't have the TikTok, but they did buy Oculus and some of this, so now they want to be able to pivot and leverage some of that VR and all that. But Drew and I were just talking about this earlier too. I mean, it's going only to get more and more sophisticated online for people to be able to do their business online. Now, whether or not they're going to put on a VR headset and actually enter into a room where they have an avatar and everything is kind of like this next, sort of bigger jump in phase. But there still is this idea. We've got a friend in the domain space, Morgan Linton, who has a company called Bold Metrics. Their business is all about making it easier for people to buy clothing online because their sizing and everything. They've got some really interesting stuff that they've developed around how to better select clothes that you buy online that better fit you, as opposed to just, small, medium, extra large. It's like, because it's,
I really hope that it doesn't turn out like that. Humans were built for connection. Well, that's the only thing we're here for. And the metaverse and everything. I mean, I don't know if you guys saw Ready Player One, the Spielberg movie, but unfortunately, I feel that's where we're heading to, because 98% of people.
A foregone conclusion.
Yeah, and I really enjoyed the book Ready Player One. We talked about this on the last show because
you did.
The movie was good. I actually very, very much enjoyed the book. But I do think we are headed in that direction where you've got also, and that's what a lot of even like we talk about the NFTs, the Bored Apes, all that stuff, it's their digital, their digital presence in some ways will usurp their physical, but people will still find ways to connect. I mean, and we saw this thing where and I don't want to divert too far off into the NFTs and stuff, but the Bored Apes had an event in Venice Beach. And there was, they had a bunch of the art displayed, on TVs.
You missed it, Drew.
So I know this is where he would have been. And there were some other NFTs, not just Bored Apes, but I was telling Drew. But the folks who couldn't be there live were actually in one of the metaverse apps. I think it was Decentraland. And not Sandbox, but where their avatars were in, and they were actually like intermingling with the physical folks. right? Or at least able to see into the live feed, the video feed. And, you know, and Robert Iger shows up in the room and, you know, shorts and a t-shirt, and they're taking pictures of him standing in front of, I think, a piece that he bought, one of these crypto Venetians, these Venice Beach surfer pixelated crypto punks looking things. And it's just such a wild time that we're in, where you've got this like kind of intermingling of, you know, but what I think it drives towards when we're talking about domains, and to reset the room and kind of bring it back to what we're talking about today, it's that, you know, the idea that your digital presence is absolutely key. It's going to continue to drive the value of domain names, because they still are going to be an anchor for, you know, bringing folks to the internet, right? And that is only going to become more and more important for everyone. We're seeing the trends. We talk about it all the time, COVID and otherwise, and it continues to drive the value of domains and digital assets and digital properties, and, you know, which makes them even more enticing for folks to get in.
Yet, all that
100%.
being said, yet the vast majority of the world has absolutely no, and when I say vast majority, I'm talking 99.8%, have no idea that domain names are valuable, how much they could be valued for, or how important they are, until they get to that single moment where they've got a business that needs to upgrade its domain, or there's a domain they just want and they have to reach out to find out, and they're thinking it's worth $100. And somebody replies back saying, no, this is going to be $500,000. And they're like, what do you mean? And what we need to do as an industry to get to being an asset class that somebody like Pedro could invest in through his fund is not that. We need to get to a place where there is a standardized way to value domains, where there is a understanding of what drives that value of, you know, all of these metrics. So
I still feel we're very much in the first innings, because a 500,000 domain is a pretty serious domain acquisition, right? I mean, there's multi-million-dollar domains, but those are very few. So where are you going to buy a good store for your business for $500,000? Nowhere. So you can still buy a store that people can access from anywhere in the world, as long as there's internet connection.
Yeah.
So that shows you the mispricing.
Coming back to Tiffany's, it's like, okay, you know, famous example, Tiffany's, $20 million a month to have that store on Fifth Avenue, $20 million a month. And why? You know, it's obviously a loss leader, but it's, you know, it's marketing budget. And, you know, how do you justify that? And then look at domain names, which, you know, that $20 million storefront, $20 million a month is, or it might be 20 million annual. I don't remember. It's crazy numbers. It probably is 20 million a month. But there is a finite supply of people that can walk through that door, and it's limited to the number of people that walk past that door every day. And only a finite number of those people that walk past the door every day are actually qualified buyers, and an even smaller number of them are qualified and interested. And yet they're very happy to and have paid for an infinite number of years that kind of rent to have that type of prestigious storefront. How do we go? And this isn't a rhetorical question, to segue into maybe some of your next questions, but how do we go as an industry, domain names? How do we go from what you said, a $500,000 domain name is a drop in the bucket relative to other budget items, right? It does not in any way reflect the utility or the prestige that comes with these assets. And again, you know, even if you bought that storefront for $20 million, it's still going to cost you, let's say, what is it, 1.5% a year in property taxes?
Yeah, exactly.
That alone, you know, what is that? That alone is,
but
is like
I
hundreds and hundreds of thousands of dollars.
I think the way we answer your question is we're going through a change. We're going from the analog to digital change very slowly. You see how the central banks are looking at Bitcoin. You know, Bitcoin is one of the simplest things. I mean, they're all PhDs in economics and whatnot. I mean, they cannot understand what comes out on a white paper that is 8 pages long. I mean, there is a changing of the guard from the analog to the digital. The guys at Tiffany's who make the decision, they're not the 30, 40 or somethings. It's the older ones. So, yes. And you guys, in my humble opinion, you're not doing a good job at explaining and educating everybody who is not in the industry about how valuable the assets that you trade are.
No, that's a
So,
fair point. And I was-
100%. That's
Yeah.
why we got you here today, Pedro.
This is part of
so
the amplification.
you know,
And
we
really-
found 2 revenue streams for you guys already. The index, which then you can start passing it on to the CNBCs of the world and so on, and the Bloombergs and so on, and have people that write things about domain names and the industry, so that you educate people. Because Wall Street is so lazy that you need to spoon feed them spoon by spoon what you want them to understand.
Yeah.
And that's the same problem. I was reading a very interesting article on Bitcoin, why the yuppie elite is so quick at bashing Bitcoin, because once you crack the code of understanding the Wall Street jargon, they get too lazy to learn new things. Everything can be transformed into cash flow statements and understanding a business and so on. A new thing, they just dismiss it, too lazy. You know,
and most people are one-trick ponies, right? They learn one thing as their career, and that's the one thing that they do throughout their life, and they're not interested to retool for learning something new.
With one caveat, the world, the rate of change in the world was super slow.
Yes.
The rate of change in the world is completely different now. And going ahead, it's going to be even faster. If you already feel like your mind is buzzing from all the information that you have to absorb. I mean, I was reading the other day, the amount of medical data in the world doubles every 72 days or something. I mean,
that's crazy.
There's the knowledge because of AI is starting to interpret a bunch of things. It's incredible. So as that progresses, people need to learn new things. Learning one thing in your life used to be okay in our parents' generation. In our generation, you're going to have to go through 4 or 5 transformations. I mean, if you want to keep operating at the high level. If you don't want to be at a high level first, that's fine. Learn one and that's fine, and you'll do as you will. But I mean, we are competitive people. We love learning and so on. To stay on top of our game, it's a game of constant learning. It didn't used to be like that.
Yeah, and that's a fair point. But really quick, just to double back to the Tiffany's thing, I don't know what it costs them every year, but I know that they're doing a renovation of their store on Fifth Avenue, and the cost of the renovations alone are going to cost somewhere between 125 and 250 million dollars just to renovate the store. And that's that's part of what they've got going on. And so when you think about that, just to renovate that location, that physical location that accounts for less than 10% of their global annual business. That, and the idea that a domain name such as diamond.com, which is a diamond in itself, is not worth, $1 million, $5 million, $10 million.
Exactly.
$100 million.
Yeah. Well, I mean,
but I mean, whoever holds that domain should just hold it until it's worth what they believe it is. It's a question of faith.
Well, and then and then a shout out to a guy like Rick Schwartz, who is one of the, call him an old school domainer, but he's one of the most successful domainers in history. And part of Rick's success is that he's always valued his domains at what he's valued them at, and has held out for the right value. And eventually the buyers come, and it may take
took 20 years, but eventually buyers started showing up at the values that he said.
Yeah. And, which also shows you the appreciation of domains and is digital assets over time too. And, but it's about bridging that gap. And then how do you monetize that in the meantime? And then how do you properly, how do you speed that along so that you don't have to wait 20 years to get the return on those investments at the level that you think?
Listen, I don't mind waiting 20 years. I'm not a trader. Most of my investments in our fund are 3 to 5 years timeframes. As long as the value is appreciating over a 3 to 5 year period, and you can find a reliable and conservative way to mark them to market, I don't need the liquidity to sell them immediately. I wouldn't put 100% of the fund in domains, but I can conservatively put 5 to 10%. And then if I can value them on a mark to market, and if you guys provide an index, valuation services, and so on. And then, the important thing is that when one wants to sell, that it kind of, if you guys are overestimating the growth of the index, and then when we sell, we realize that it was 20% or 30% lower, then that's not good for anyone. So it needs to be a fair index that you guys feel represents really the average price. And it could, the slippage cannot be much from that price.
Yeah. I think that's
so we're pushing up on an hour here. I mean, I can go longer about it.
I think we
take up
just
too much
barely
of your
scratched
time.
the surface.
But yeah, I know. I feel like this could be.
I'm on question number 2 of 12.
So you want to go quick, like a rapid fire round and fire out some of the questions?
I'll do. So the next one is, I noticed that a lot of the new crypto businesses come with domain extensions IO. And I wanted to, because I've understood from you, Drew, that .com is like le crème de la crème, and then it goes down to .net, .biz, and which I've heard many times mentioned. Yeah. So what's the scoop with .io? Is that becoming the domain extension of the cryptoverse?
So my opinion, which I think is well supported by the facts, is that there's .com, which is the best, and then there's the rest. And among the rest, you have several different extensions which are sort of vying for second place, and each maybe has certain verticals where it's more dominant in. .io has been very well adopted in the crypto space, but what I've seen personally through our business is that it's training wheels, right? So it's okay, I've got this new project. I need to put out a white paper. I need to put out a landing page. I'm not going to go out and spend hundreds of thousands or millions of dollars to get that exact domain. So I'm going to stand up my website on a .io, or in a lesser case, a .co, or to a lesser extent .org. And those are kind of the three, I think, that get most of the attention in the crypto space is and probably in that order: IO, CO, org. And once they hit a tipping point and they are, let's say either raise sufficient capital or a proven success, then they upgrade to the .com. And I would say, a large majority of our domain sales, both outbound and inbound, are to companies that are upgrading from a .co or a .io. So Great way to start, and then later upgrade to .com.
Yep. And the only point that I'll make on top of that, it doesn't mean that there's not an opportunity to invest in those in .io domains. I mean, there still is a very, very good opportunity to buy low, sell high, because they are selling and trading at decent prices, especially for, call it a second tier domain extension, and because there is a level of popularity amongst crypto and NFT companies to utilize .ios, and they are sort of a great starter domain and a name that people will spend, maybe tens of thousands of dollars, if not even hundreds of thousands of dollars potentially on their domain, when the equivalent .com would be worth $1 million. So,
yeah,
but there's still an opportunity to make money within that space, because and there are folks and folks that are part of our sort of extended team here that are very bullish on .io and do very well buying and selling .io domain names.
I, however, am not one of them.
Except that you literally had one of the biggest reported .io sale ever.
I have the two top domain .io sales ever in history. But I'm not bullish, and the reason for that is I think you can look at any other asset and you say, okay, there's the best, and then there's the rest. And if you're in the rest, you're always going to be encumbered because you're always second best. And if you're second best, then there's a ceiling, right? Because as soon as .io prices start pushing up on .com prices, there's a margin there. And at some point you get close enough to say, well, it's only 30% less than the .com. It's only 50% less than the .com. I'd rather just go buy the .com, because I know if I'm successful, I'm going to have to upgrade anyways down the road. I might as well get the .com. Maybe I can get it on terms. Maybe I can, finance it, whatever. But I just think that there's a ceiling. Whereas if you're number one, there's no ceiling. Like, you need the .com. It's never going to bump up on anything. There's nothing overhead. Whereas if you're in IO, .co, .net, .org, you're always going to bump up on the .com. You can only go as high as some margin below the .com.
That's fair.
Who is the central entity that we have to trust on the .com domains?
There's two.
Like,
VeriSign.
is there a registrar?
Well, it's a registry. Registry. It's VeriSign is the registry that effectively manages the .com registry. And above them, from a regulatory standpoint, you got ICANN, which is the regulatory body governing.
Okay.
So those are the two from the .com perspective.
Any chance that another domain extension that is blockchain based starts getting traction because is seen as more digital rather than the analog?
Well, there's a lot to talk about there. That is
that's a deep rabbit hole.
And
the short answer.
Go ahead. I'm sorry.
No, that's okay. Go ahead.
A lot of crosstalk. If the
Right.
transcript,
So the short
answer.
The short answer of this is yes. Right. There is a whole Web 3.0 that's emerging, and there are several players. Let's say two key players who are pushing the innovation and adoption of Web 3.0 from a domain name standpoint, right? And that is like unstoppable domain names, of which I'm an investor for transparency's sake, and Handshake, which is I am an investor into names, but not into, there's no companies, a decentralized, protocol.
Right, but they have a token and then the names themselves. So yes. You got both.
But I would argue that until the entirety of digital commerce adopts a decentralization architecture, .com remains king. And I just don't see that happening for, let's say in a best case scenario, we're talking about 10 plus years. And I think more likely you're talking 20. If I think about, ICANN, and I'm on the board, not on the board, but on the several of these, what do you call them? Working groups. And, if I look at the time frame in which a finished product of a working group gets adopted at the protocol level at ICANN, it's 5 years. It's like 3 to 5 years that's like fast track, right? And so for us to move to a fully decentralized architecture for the entire internet, honestly, 20 years could even be optimistic. And so I think that, and I also further nuance that with, I'm not actually sure that Web 3.0 is a replacement to our current internet. I think that it's a supplement. I think that what we're going to find out is that this is my current ongoing and subject to change thesis on Web 3.0, is that Web 3.0 will be the identity layer, the ownership layer, and the transactional layer of the internet. And it will be supplemental to, it'll be the way that we can obfuscate ourselves, maintain our privacy of our data, potentially maintain some pseudo anonymity, but interact with the internet that we have today, right? In its form.
If I read what you're saying properly, this would potentially be an issue more for a VeriSign than for the domain owner.
Yeah, 100%. And I think that, whether it's decentralized or whether you're talking about Web 3.0 on a decentralized, or you're talking about the current internet, you still run into human behavior. And I think human behavior is such a important factor that gets just disregarded when we're talking about, COVID mandates or Federal Reserve or, all these major issues. I think people just ignore human behavior and they try to look at things in a vacuum. And that's such a big mistake. And it probably is the reason that we have a lot of problems in the world today. But I think that .com is just ingrained. There has been literally trillions of dollars invested into advertising and marketing and branding that is ingrained into human behavior now, to the point where if I tell you that my company's called Apple, I don't need to say the .com as long as I own it, right? You just inherently believe or understand or assume that you're going to find me at apple.com. And so anything other than .com is an encumberment on your brand, because you need to further explain to somebody where to find you. If you're not apple.com, you need to say I'm apple.io. I'm apple. We literally just saw this with Clubhouse, right? So you had Clubhouse.io, which was, I get it confused. I think it was Clubhouse.io, which was like a software company. And then you had all of a sudden out of nowhere, Clubhouse, that we all know about, emerged, the social media app emerged. And they were, I think, Clubhouse.co maybe, or I don't know. I might be messing up the extensions. All I know is neither of them had .com. Then Clubhouse, the social media app, upgraded to the .com. And the guys on the IO who were older, had been around before that, instead of just saying, oh, we're going to just stick with our game plan, this is who we were before, this is who we're going to continue to be, they really were forced to do a complete and total rebrand.
Yeah.
And they've now rebranded to shortcut.com.
Yep. And by the way, good job, Drew, on the facts. You were right. It was clubhouse.io that then had to rebrand to Shortcut because Clubhouse, the social media app now that we all, like you said, and that they've effectively got pushed completely off of their domain and out of the realm of like, awareness, and had to go rebrand. But let's not,
and so it's an important point, because it doesn't matter, again, decentralized or not decentralized, doesn't matter. It's about human behavior, and human behavior means that as it is today, and again, human behavior, you can go out and look at the social studies, human behavior takes 2 generations to change. You want to change human behavior? 2 generations. Today, human behavior is still ingrained with .com. And so that's why I say 20 years minimum to change that.
And that same point, that same thinking holds true when you got somebody who's going to buy a name. If your brand is Apple and you settle on a domain like getapple.com, right? As opposed to just paying for the single keyword that represents your brand, if that's your brand, eventually you're going to also then have that same issue where now your issue is to the left of the dot, but it's the same problem because you're going to have email leakage and all sorts of different challenges that you're going to have if you don't have the name that actually represents your brand. So if your brand is, and that's what you decide to brand as, and your logo and everything else is like this, single one word, that's a great word, but you go with some variation for your domain name, same thing around certain misspellings, like you're going to end up really hurting your business, which is why, you're better off spending the money, coming up with some sort of creative way to finance to ultimately, get into the domain that you really need for your business at the end of the day. But not to get too far down that particular rabbit hole, because now we're in like rabbit tunnels of the rabbit hole. And I know you still have a bunch of questions. So let's move on to the next one, unless you have further follow-up on that.
How large is the market of domain investing, and what parts of the world are more active?
That's good.
So hard question to answer, very important question. Because of what we talked about earlier with the lack of transparency in pricing, I don't think anybody really knows. Maybe escrow.com is a decent indication, but I think that, we basically believe more or less, I think it's more or less consensus that the domain name aftermarket is roughly $2 billion a year in turnover. So that's, domains that expire, domains that go to auction, domains that are, sort of P2P transactions, domains that go through brokers, marketplaces, et cetera. I think we're talking about a $2 billion market. Could be 3, could be 1. I think 2 is about right. I don't think it's 5, and I know it's not less than 1.
Yeah, and interestingly, there's an article that came out in Forbes, which came out in March of this year,
which was more or less in line. I think it's a little low, but it's more or less in line.
Well, they said the value of the entire DNS, the domain name system, was $8 billion, was what they had said. Now, that's not the aftermarket. That is the because you've got domains that are registered, and at GoDaddy and the other big registrars, so they know what the renewal fee costs are, and and everything based off of that. So
that does not include the aftermarket, or it might include some component of the aftermarket, because probably GoDaddy's aftermarket sales are included in the data that they're picking up. But my guess is, including sort of initiation and renewals. So initiation meaning like you go and register Pedro de Noronha right now. And renewal being next year when you renew the domain.
See, JT, I told you he could still not say my name.
I know. I was going to comment on it. I was going to correct him. But yeah, they actually said in the same article, the secondary resale market is $2 billion with the purchase and renewal of .com domains. But I don't know if they're capturing just what's happening, at GoDaddy and what's being publicly.
Yeah, I think it's. Yeah, I think you're probably talking 10 billion combined with initiation, renewals, aftermarket. The whole thing.
And geographic exposure, is it mostly North America, or?
It's pretty global. I mean, that's
heavy skewing. Well, if we're talking .com, it's a very heavy skewing towards North America. And then probably we were talking about Europe. I'm not actually sure is the honest answer, but definitely there's going to be a heavy skewing in the aftermarket. There will be a heavy skewing towards North America.
Well, I mean, if you guys look at your yearly sales and you classify clients as North America, Latin America, Europe, and Asia, how would the splits be?
Yeah, well,
In
for
dollar
us,
terms, not in number of clients.
yeah,
Yeah, for tax purposes, I'd rather not disclose. No, probably it is 60%, 70% North America.
But what I can
Okay.
tell you is, having managed the NameJet, the domain name auction platform, for several years, we did have this wave of Chinese investment that had come in.
That's
and
true,
then,
actually, yes.
and then
The
that
numbers, they were buying the numbers domains, right?
Yep, and well, and the short domains as well. In fact, it got to the point that there was so much activity around the aftermarket, around these, like, those different classes of domains, the buckets, that they actually had an app that was similar to, like, the Apple stock app that you get on the iPhone, that showed, like, okay, this is what 3-character.coms are currently trading at and everything else. So,
Wow.
but it didn't maintain enough momentum. The wave kind of settled. But Asia still, especially in China, still maintains a very big presence in the domain aftermarket. Especially with the shorter, like the 2-character.coms, 3-character.coms, the numeric domains, like you said, because of the use of the numbers as part of, like, sort of the language system and everything else. But yeah, if you look at our numbers, I mean, we don't have a ton of Asian business. I mean, looking at media options, largely skewed to North America, with some Europe, with a European presence as well, and I think that's,
although India is an emergent market for us. Whereas in the past you had a lot of inquiries out of India, a lot of tire kicking. In the last 18 to 24 months, we're really starting to see some serious activity coming out of India. There's some really big moves happening in India. The global digital commerce is really moving in a big way in India.
And I was going to say, so where Asia is now entrenched as a pretty big player in the market, India is growing, and that I can say just from a registrar perspective, because that's almost where you look at it from. You've got the registrar trends, which is sort of your initial, hand registration and other activity that takes place at the registrar level or the registry level, and then it kind of segues, it follows along in the aftermarket as well, and as these players are getting bigger and taking on a larger sort of chunk of the business. But for us, it's just, some of it is just, we don't, part of it, we just focus on the clientele that we have. A lot of our buyers are startups, that are, and a lot of them based in California, although now we're also seeing a larger spread there because everything is becoming a lot more distributed just in general. So
yeah, that makes sense. And how do you think domain prices correlate with other assets?
Great question. So this is something I've thought about quite a bit, and it's one of the things that attracts me so much to domain names, and why I just continue to just keep dumping more money into buying more domains, is that I think it's one of the best uncorrelated assets, or maybe the most uncorrelated asset in my universe. I think that we're in a macro trend. One of maybe the largest macro trend is digitalization, right? We've been in this for 30 years and it's only accelerating. We're getting really steep in the curve now. And there's a 0% chance, outside of some electromagnetic shock that shuts down the global, grid and internet. I don't, there's no way that trend is reversing at all or slowing down. It's only going to continue to accelerate. So if we take that as a baseline, then no matter what happens in terms of the Fed, no matter what happens in terms of the S&P 500, there will continue to be an increased demand for domain names and a decreased supply of great domain names. There will be an increased supply of domain names in general, because we have, there will at some point be another round of GTLD applications with ICANN, meaning that you could go get .pedro, whatever, right? There will be another round of that. We have currently roughly 1,000 domain extensions, not including country codes, generic domain extensions, and there will be more in the future. And so there is a seemingly infinite number of potential domain names, but the number of .com domain names, the number of meaningful, inherently valuable domain names is very finite and decreasing rapidly. And so
just like real estate, right? I mean, there's an
Yes,
infinite
except
amount
that
of
real
land
estate's
that you
gonna
can
be
buy
mo-
to build a house.
Real estate is going to be more correlated, I believe, physical real estate, because people's behavior, so such as COVID strikes, people, let's just take it at face value and say that, yes, people left San Francisco, people left New York, they migrated to other jurisdictions. Well, that real estate now is, the value of it is encumbered in some way, right? Because there's a lower supply of qualified and interested parties to either live there or rent it for commercially, right? And so, but in the digital landscape, none of that matters. It only matters is, will there be one more digital business tomorrow than there was today? If the answer is yes, price over the mid to long term must go up, right?
Yeah.
And it's the same principle. This is why I really got very confident early on in Bitcoin is I, for whatever reason, maybe I'm even stealing this from somebody that told it to me, I don't know. But it was, I broke it down to a very simple question, which I think I said to you once. It's just, I wake up every day and I ask myself, and I literally do this, do I think today there will be one more person that wants to own Bitcoin than yesterday? We know the supply is fixed. And so if I believe today there will be at least one more person that wants Bitcoin than yesterday, price must go up. Maybe not today, but as the waves get, what is the word?
Crowd psychology.
The trend will be up. Yeah. And so the same thing he said here.
The interesting thing is that we're talking here about the numerator of the fraction, be it Bitcoin, be it domain names. There's scarcity, there's tailwinds, there's the digitization of the economy. What we haven't spoken much about is the numerator, which is which currency is it denominated on. And when you have a fraction, the numerator might not even move, but when you have the denominator, as we have now, which is fiat currency, being debased at 10-15% a year, I mean, your domain might not even move, but it just increases by 10 or 15% a year in dollar terms, just because of the actions of central banks.
Yeah. Just because of debasement.
So when you own a digital scarce asset, you're actually making money on both sides of the fraction. The numerator is going up because of the scarcity is increasing. There's more digital businesses opening every day. And the denominator is going down because of the outrageous actions of central banks. So
shit, JT, we got to raise prices right now.
That's what I'm saying. I'm ready to, I'm jumping off this call right now and I'm going to go update the sheet and, I'm going to grind.
You're absolutely right.
Let me just make a last question, because I think you guys have a large portfolio of domains, right?
Relatively speaking, it's not a large portfolio. I would say it's a very high quality portfolio, but
high quality.
6,000.
To somebody who doesn't have a lot of domains.
Some guys who got 5 million.
Yeah. To somebody who doesn't have a lot of domains, we've got a big, very valuable portfolio of domain names.
So here's the challenge. Why don't you guys launch a domain fund? And it could be like you see many of the tech stocks when they IPO, you just IPO 20% of it. And you yourselves create an index, you give the valuation services, and I know there's potential conflict of interest, but if you're allowing investors in and out at the price that you're saying, you have an interest to value the portfolio fairly. Yep. Otherwise, investors start getting out, and you get stuck with the domains that are worth considerably less. I mean, that's one way you could have the first mover advantage of putting domain names as an asset class in the face of investors. Because once you have a fund out there and you have 1 year track record, 2 year track records, and you can measure correlation on a monthly basis, you can see price appreciation and so on, it becomes undeniable. You kind of have to force people to do the work.
So I agree with all of that, and there will be some updates on that front, tangentially speaking, soon. But one of the points I wanted to get to today, which I don't know if you had a question on this or not, is around cash flow. And in a world where corporate profits are flat, right, have been for a decade plus. Even if revenues are increasing, profits are flat, margins are flat, right? And so, or decreasing. And if we start seeing wage increases, that's going to further compress, margins and profits, et cetera. And so, we have Bitcoin as, the hottest asset class, in the world, arguably right now. You've got, all these things that sort of push up on a traditional value investor thought process and valuation model of, future value cash flows, right? Couldn't be, it's a very easy way to value something. How do we overcome that hurdle in the domain industry? Is there anything you can look at in this industry and say, well, yes, obviously that's true. Obviously you're valuing the equities you invest in based on cash flow models, but you're also an investor in Bitcoin, which has no cash flows. Domain names can have cash flows if they're actively managed. They can have cash flows if you're leasing it or if they generate significant type-in traffic. But ignoring that for a moment, how do you solve for that?
You have to learn how to be comfortable in investing in assets that don't produce cash flow. That's the short answer. And I can give you an example. I'm a diehard value investor, have been since I launched a fund in 2008. And as you can imagine, value investors were kind of out of favor since 2008 started, because with unconventional monetary policy at zero, growth companies are outperforming massively. So the way you convince people is, one, by doing what I told you. Either you create an index that shows them that cash flows don't matter because there's a kind of like a sound policy behind the valuation and the creation of that index. And that's what I have, the frontier I had to pass for me to invest in Bitcoin in the first place. Because, as a value investor, if I speak with my friends that I meet in Omaha every year at the AGM of Berkshire Hathaway, I remember in March of 2020, in the middle of the lockdown, I called one of my Omaha friends and I said, listen, I have a heretical thought in my mind that I need to confess to you. And he tells me, what's that? And I said, the more I'm reading into Bitcoin, the more this looks like the most perfect value investment that I've ever found, because it's trading a 90% discount to what I think its value is, but it doesn't produce cash flow. So, and his answer completely surprised me. He was like, Pedro, we were wondering exactly the same thing over here. We're getting to the same conclusion. And this is value investors. We're not talking about tech investors, venture capitalists. We value above anything cash flows. But give us 10 years of underperformance, which is what happened to the value industry. Give us a world that is changing. And, one of the things that I usually say about Michael Saylor is that he's the Warren Buffett of the new age. He has outperformed vastly Warren Buffett since 1990 with his domain names investing, then tech, and now with all that he's doing in crypto. And I think there's a lot of people still stuck in the cash flow investing. And it's great because the world needs to work with copper, with all the commodities that will produce the ASIC miners and all the computers, so that people can live in a Ready Player One and an Oculus experience. So that still the world still needs to circle, but investors right now are not valuing that at all. So I have companies that produce lots of cash flow trading at 9% dividend yields at 5 times earnings. I mean, you would look at that, it doesn't exist, but it exists in this market where people are more and more investing in ETFs, in S&P 500 ETFs. They don't care. They just want to own Amazon. They think Amazon is the sure thing. And Amazon is a great company, but everything, as we were discussing in the beginning of this call, has a price. You'll make a price for any 3-letter domain. I'll make a price for literally anything. You might not like the price, but I'll make you a and I'm learning, because I'm kind of being forced to, because if I don't learn how to invest in non-cash flow businesses, I'm out of business. It's game over. So I think what you need to do is to create an index, start up a fund, and be the pioneer that launches this new asset class. Because it's either you or one of your competitors, or you guys can do it as a joint venture. Someone needs to do it, because coming back to most investors are lazy.
No, and I think that's great. And with that, I think we've kind of crossed over time. And But this is inspiring for us, and I think it's extremely interesting. And getting your perspective on this. I mean, look, you're a brilliant guy. You've had a ton of success. You have a
Don't make his
different.
head too big, okay?
Well, yeah. Well, it's the only way you'll fit in the room with Drew, right? The but you have this really interesting perspective, which for us, we are constantly discussing this, which is why we wanted to have you on the show today. And I think having you approach it where you kind of became the interviewer, I think is a really fresh, great way for us to have gone through this. And honestly, we went through an hour and 45 minutes here, and it felt like we talked for 15 minutes, right? And we've got a lot
Happy to do it anytime, guys.
Oh, and it's
Anytime
awesome.
we can do it, take two, because I tell you one thing, Drew, if you did a fund, I would definitely invest in it, because I do believe in the asset class. But I don't have the expertise, I would need a guy like you guys to have skin in the game. Like you guys own 80% of the fund, that's fine. I can own 1% of the fund, because I know if it doesn't work out, it's much worse for you guys than for me,
Sure.
So that's kind of I like the alignment of interests in every of my investment thesis. There's always an alignment of interest component.
Yes, critical.
And I do think as time goes, and we're in this digital age now, where it is becoming more enticing and palatable to, like you said, value investors are recognizing that it's not about cash flow, and it's about making sure that there's confidence around what the real value is, because that's where you've got this delta between what the current sort of price is versus what the potential is, kind of that subjective value delta that Drew was talking about earlier.
And it would be a great exercise for you guys, and relatively easy to do. All you have to do is put your portfolio of high quality domains into a fund. You own 80%, you kind of IPO 20% of it, and then you just value it on a monthly basis. If you have subscriptions or redemptions, it doesn't matter. You're creating a track record. And when you do, you just put them at whatever the NAV is, and you see how it progresses. It would take maybe 2 to 3 years to establish a track record. But once it's there, you have a huge first mover advantage. And it's a new asset class. And there's still $300 or $400 trillion of bonds out there. And a lot of those bondholders are not required by the regulator to have those bonds. But it's these boomers who were always used to have the 60-40 portfolio and stuff. And right now they're catch like a deer on a headlight, they don't know what to do. So they're selling their bonds and buying Amazon. And they don't realize that they're buying a great company at an extraordinary price.
Yes.
Yeah, no,
and
absolutely.
Whereas they could be buying other things like digital assets, like crypto and so on, to diversify. I mean, anybody who has bonds on their portfolio and doesn't have Bitcoin is totally irresponsible.
Yeah, they're negligent at this point.
Yeah.
I one of the takeaways I have from the conversation today is just like, it's on us. We as an industry, should be ashamed of ourselves for not doing a better job of communication to the broader, investment community, because, we see things, other digital assets, whether that be Bitcoin or the 1,000 other shit coins, or NFTs, or what have you, booming. And yet here we are with an asset class that is 30 years old and is literally the backbone of the entire global digital economy, arguably one of the most important assets on the vast majority of companies' balance sheets that are digital companies. And yet so few people understand the value. So few people are willing to invest into the value.
Because you're too busy. The problem is you guys are too busy buying and selling and trading and finding that you don't have time to develop this. But this is the domain 2.0.
Yeah.
You need to make it institutional. This asset class could be institutional.
Well, and for
because
what it's
people,
worth, go ahead, Pedro.
People could rent domains, Like the owner of a domain can say, listen, I'm not gonna, just like you rent the Tiffany's Fifth Avenue store for 20 million a month.
Yes.
Maybe someone will have diamonds.com and people will say, listen, I want to buy it. The beers, no, I'll rent it to you, $1 million a month.
Yeah.
There's plenty. You're in the beginning of the first inning of domains.
I agree.
Yeah, and that's what's really exciting. And you know, we do have some things that we'll be announcing that I know, we know about, but that we can't really disclose. But then
in the interest of full disclosure, I have no idea what you guys are going to announce. So.
And then from there's things kind of what we're talking about here that represent some of the opportunity that we're also talking about exploring. And we've got some pretty cool things but as far as this conversation has moved along, we may not be able to publish this show because I think after we get off the call here and off the show and we pivot and we start our fun, we don't want to necessarily let the cat out of the bag too soon now, because we're going to take what you're telling us, Pedro, and we're going to go get started. Yep. So now we can't let the public know. But
you can always cut that part off. You can always cut that part off.
Everybody's lazy. It's not just institutional investors. Everybody's lazy.
But I could sit here and
I could spend 5 hours and I could lay out my entire playbook, and I can guarantee you that not one of the thousands of people watching this show will execute on it. It's just unfortunately human nature.
No, it's all good.
It's time arbitrage. You guys are having a very good time in the short term. You don't need to focus on the medium term, because deals are happening. You guys are brokering deals. You're making good buys, and then you sell them in 6 months or 1 year time. You're doing it on a proprietary basis, which is great. Now, if you want the industry to go to the next level and for institutions to come in, someone needs to be the pioneer.
Yeah, and we're actually the best situated to do it without question. So, especially with the network and the folks that we could bring in. And I mean, look, there's no doubt. And look, this is also part and parcel of things we're already talking about. So there's a lot of exciting things coming. And but we're going to set up a part 2 because there's going to be more to follow off of this. But this was a great
pleasure.
And Pedro, thank you so much for joining us. Thank you to Drew as always, but thank you to you for being here, Pedro, because this was it's a super interesting show that I think our audience is really going to like, especially our core domain investor audience. And with that too, I want to thank the audience, because as I say it on every show, without you all, there's no us. So thank you for joining us today. Please be sure to comment. Let us know you got questions, you got comments, you know how to find us. Find us on Twitter, DomainSherpa.com. Leave a comment under the show, all that kind of stuff. And you can find Pedro if you want to see more of what he's got going on at Noster Capital, which is Noster Capital, capital.com is his website. So feel free to go check that out and find out more about him. You could also find him on LinkedIn and other places online in the digital space, as we all are. And so with that, we're going to get going. I want to thank you again to you guys, Pedro, especially you.
Before we do, Jake, Pedro, do you have any ask or request or shout out or anything you want to say to the audience?
No, I mean, I hope they've learned as much as I have in this hour and 45. It's been super interesting to learn more about the domain names.
All right. Well, excellent, man. Well, thank you so much for being here. Thanks to everybody. And we'll see you guys next time on Domain Sherpa, where all roads lead to domains. Bye.
Thanks, guys.